Picture a landlord who owns a 40-unit apartment building. He's got $8 million of debt on his shoulders, a mortgage payment due on the first of every month, whether the units are full or empty, and a property value that can drop 20% the second interest rates move against him. Now, picture the company he hires to actually run that building. They own none of it. Not one unit, not 1 square foot. Their name isn't on a single deed, a single mortgage, a single insurance policy covering the physical structure. And yet, that company can walk away with $100,000 a month in revenue, more predictable than the landlord's own rental income, without ever touching the risk that could wipe him out overnight. Here's what nobody tells you about hitting 6 figures a month in this business. It isn't about owning more real estate. It's about surviving the gap between how simple this looks from the outside, collect a fee, answer the phone, and how many separate revenue streams you actually need stacked on top of each other before that fee alone gets you anywhere close to $100,000. The landlord's risk is the building. Your risk is entirely different. It's whether you can run the operations underneath hundreds of doors profitably enough that the fees actually add up to something real. $100,000 a month sounds like one big, satisfying number on a thumbnail. In reality, it's never one number at all. It's 5 or 6 separate revenue streams, each one modest on its own, stacked on top of a portfolio large enough to make all of them matter simultaneously. Let's build the real math behind that number, starting with the one fee everybody assumes is the whole business. Block 2, the management fee floor. The management fee is the foundation, and on its own, it barely gets you off the ground. Most residential managers charge 8 to 12% of collected rent, not the property's value, a single month's check. Run the math backward from $100,000 a month. At 10% on an average rent of $1,800, you'd need roughly 550 doors generating that fee alone every single month, with 0 vacancies and 0 late payments. That's not a side hustle. That's a company with a real office, real staff, and years of accumulated portfolio. And here's the part that trips up almost every operator projecting toward that number. The fee only exists on rent that's actually collected. A vacant unit, a tenant mid-eviction, a check that bounces, none of it counts toward the number you're trying to hit, even though all of it still generates the exact same amount of work. This is also why the management fee alone is such a slow, grinding path to 6 figures. 550 doors doesn't happen overnight. It's typically years of steady account acquisition, referrals, and retention. And every single door added has to survive its own vacancy cycles and tenant turnover along the way. Nobody builds a $100,000 a month company on this fee structure alone, which is exactly why every serious operator starts layering additional revenue on top almost immediately. This is why nobody serious tries to hit 6 figures on management fees alone. The leasing fee is where the real acceleration happens, charged every time you fill a vacant unit. Commonly 50 to 100% of 1 month's rent, paid once, upfront, by the owner. On a 500-door portfolio with typical turnover, you're releasing somewhere around 150 to 200 units a year. At an average leasing fee of $1,000, that's another $12,000 to $17,000 a month, layered directly on top of the management fee base. It also means the path to $100,000 a month isn't a straight line up from more doors. It's doors multiplied by how efficiently you turn them over. A portfolio with healthy, well-screened turnover can out-earn a larger portfolio full of long, quiet tenancies that never generate a single leasing fee. Block 4, the maintenance markup engine. Here's the layer most owners never see coming, and the one that quietly does more work toward that $100,000 number than almost anything else. Every time something breaks, and across 500 units, something breaks constantly. A vendor gets dispatched and the invoice gets marked up 10 to 20% before it reaches the owner. Run that across a portfolio this size. A company managing 500 doors commonly processes 200 to 300 maintenance work orders a month. At an average marked up invoice of $400 with a 15% margin baked in, that's another $12,000 to $18,000 a month. Money that shows up on nobody's radar except the person running the company. Some operators push this further and bring maintenance entirely in-house, capturing the full labor margin instead of splitting it with an outside contractor. Done well, that single decision alone can add another $10,000 to $15,000 a month once you're operating at scale. But it also means carrying full-time technicians on payroll, whether the work orders come in or not, trading a variable cost for a fixed one that has to be justified by volume every single month. None of the individual fees below this line look like much on their own, and that's exactly why owners rarely push back on any single one of them. A lease renewal fee, charged even when a happy tenant simply stays another year, commonly runs $100 to $200. A new property setup fee runs $200 to $500. Late fees often split with the owner or kept entirely by the management company. On a 500-door portfolio, with roughly a third of leases renewing in any given month, renewal fees alone can add $3,000 to $5,000 monthly. Add setup fees on new accounts, split late fees, and administrative charges, and this entire category commonly contributes another $5,000 to $8,000 a month, invisible individually, meaningful in aggregate. This is the layer that separates a company doing $60,000 a month from one doing $80,000. Nobody builds towards six figures on one big fee. They build it by stacking 6 or 7 smaller ones that all draw from the exact same portfolio. Here's a stream of cash that never touches the owner's side of the ledger at all. Application fees charged to every prospective tenant for a background and credit check commonly run $40 to $60 and often exceed the actual cost of running the check itself. Add online payment convenience fees, pet fees, and move-in administrative charges, and a 500-door company processing a healthy volume of new leases and renewals can pull another $3,000 to $6,000 a month directly from tenants. Money that exists entirely outside the management fee conversation, and entirely outside what most owners think they're paying for. Stack all of this together: management fees, leasing fees, maintenance markups, renewal and admin fees, and tenant-side charges, and a well-run 500-door operation lands somewhere between $85,000 and $110,000 a month in gross revenue. The $100,000 number was never one fee. It was 6 of them, running simultaneously. Now for the number that determines whether any of that gross revenue means anything: payroll. A company managing 500 doors commonly needs 8 to 10 people: property managers, a leasing agent or two, a maintenance coordinator, a bookkeeper, and someone handling compliance and owner communication. Blend those salaries together, and payroll alone commonly runs $50,000 to $65,000 a month. Add software. Property management platforms typically run $1 to $3 per unit monthly, plus a base fee. And you're looking at another $1,000 to $2,000 a month just to keep the operation running on functioning systems instead of spreadsheets. Office space, insurance, marketing to win new owner accounts, and vendor coordination overhead commonly add another $8,000 to $12,000 monthly. Added up, and total operating costs for a company generating $100,000 in gross revenue commonly run $65,000 to $80,000 a month, meaning the actual net profit sitting at the bottom is often $20,000 to $30,000, not $100,000. This is the gap that catches almost everyone chasing this milestone by surprise. The revenue number is the one that gets celebrated publicly. It's the one that fits cleanly on a video title or a pitch deck. The number that actually determines whether the business is worth running is the one sitting quietly underneath it, and it's rarely anywhere close to the same size. Here's the ratio that quietly determines whether a $100,000 a month company is actually profitable or just busy: doors per employee. A property manager who can competently oversee 150 units without service quality collapsing is worth dramatically more than one who can only handle 80. Push that ratio too far and you don't save money. You start losing owner accounts to slow response times and missed maintenance calls, which is the single fastest way this revenue number collapses. Keep the ratio too conservative, and your payroll eats into margins so aggressively that hitting six figures in revenue barely nets you a livable profit after everyone gets paid. The companies that actually make six figures a month work is the ones who've systematized enough through software, through standardized processes, through a well-trained team that they can push doors per employee higher without sacrificing the service quality that keeps owners from leaving. Getting to 500 doors in the first place is its own expensive project. Owner acquisition, referrals, paid search, direct outreach to landlords self-managing commonly cost a few hundred to over $1,000 per new account before it generates a dollar of revenue. And the sales cycle to win a skeptical owner away from managing their own property can take months. And once you've won the door, keeping it is harder than winning it. Owner churn is the quiet killer of this entire model. Losing 30 doors to a competitor charging half a point less in fees can erase $5,000 of monthly recurring revenue overnight. And the switching cost for an unhappy owner is genuinely low. This is why the $100,000 number isn't really about doors added. It's about doors retained, month after month, for years. Because a portfolio that churns 100 doors a year needs to constantly replace that revenue just to stand still, let alone grow towards six figures. Owners typically leave for the same handful of avoidable reasons every time: slow maintenance response, muddy financial reporting, or simply discovering a competitor down the street charging half a point less. Because switching management companies costs an owner very little, retention has to be earned fresh every single month, not assumed just because the account has been on the books for years. There's a layer of profit sitting inside the vendor relationships that most owners never see at all. A company controlling 500 doors is a massive, reliable source of business for local plumbers, electricians, and contractors. And that volume earns preferred wholesale pricing that the management company doesn't always pass along in full. Some companies also negotiate referral arrangements on larger jobs, a roof replacement, a full renovation, quietly taking a small percentage behind the scenes. It's rarely disclosed explicitly, and at scale, it can add another $1,000 to $3,000 a month, layered on top of the maintenance markup revenue already discussed back in Block 4. Here's the uncomfortable truth about this specific revenue milestone. The jump from $50,000 a month to $100,000 a month isn't a straight doubling of profit. It's usually the point where a company has to add an entire management layer: a regional supervisor, dedicated compliance staff, a second bookkeeper, just to keep the growing portfolio from falling apart. Net margins in this business commonly land between 10 and 20% once you're operating at real scale, meaning a $100,000 a month company might be generating $15,000 to $25,000 in actual owner profit, not the six-figure number the top line suggests. This is exactly why so many operators celebrate hitting six figures in revenue and then quietly discover their take-home barely moved from where it was at $70,000. The operators who actually see their profit scale alongside revenue are the ones who treated systems and staffing ratios as the real project, not the door count chasing headlines on a growth chart. It's a strange feature of this business. The milestone that looks like the finish line on a thumbnail is often, financially, just the point where the real work of protecting margin actually begins. Some operators reach that $100,000 number faster by buying into a franchise, inheriting brand recognition, proven systems, and an established vendor network, in exchange for royalties commonly running 6 to 8% of revenue straight off the top. Others lean entirely on technology, using automated leasing, screening, and maintenance dispatch to push doors per employee ratios high enough that a leaner team can manage the same 500 doors a traditional staffing model would need twice the payroll to run. It's a trade. Less personal touch service for a materially better margin at the same revenue number. Neither path removes the fundamental tension underneath the whole business. One trades independence for a system and a slice of every dollar earned. The other trades staffing costs for technology costs and a bet that owners will accept a more automated relationship. So the real decision isn't reach $100,000 a month or don't. It's this. Build the traditional staff-heavy version that gets there through headcount and hands-on service, accepting the thinner margin that comes with a bigger payroll, or build the lean, systematized version that gets there through software and process, accepting less personal control over how each property actually runs day to day. Neither path removes the risk sitting underneath that six-figure number. One trades, can I keep enough good staff to deliver real service without the payroll eating the whole margin? For, can I get 500 owners to accept a more automated relationship in exchange for a leaner fee structure? The dream was never really the revenue number on its own. $100,000 a month means very little if 65 to 80,000 of it disappears into payroll, software, and overhead before anyone sees a dollar of actual profit. The real product in this business is the discipline to stack enough fee streams, retain enough doors, and run tight enough operations that the number on the top line actually survives all the way down to the bottom one. And that's exactly why people still chase this number. Because for an operator who's stacked the management fee, the leasing fee, the maintenance markup, and every smaller charge in between across a well-retained portfolio of doors, $100,000 a month in revenue isn't a ceiling. It's a floor that keeps climbing every time a new owner signs on and every existing one renews. They know their cost per door and their revenue per door cold, down to the dollar, because that's the only number that tells you whether growth is actually building profit or just building busier work. They're not chasing a headline figure for the sake of the headline. They already ran the math on what it cost to deliver real service at that scale and made sure the business could survive its own growth before they ever went chasing the next 100 doors. Because in this business, the number on the thumbnail was never the point. The point was always whether the operation underneath it could actually hold together once it got there. And the operators who last are the ones who built for that question first and let the revenue number take care of itself.